Good morning, YouTube, and welcome back to your financial independence. So today's video is going to be talking basically all about HIMS stock, the valuation that I see, where I see this company in that next couple of years, looking out into towards the future. We're going to go over an article that was recently written, and then we have some really good news about the company. So the reason why y'all clicked on this thumbnail, HIMS stock, let's get into it. But first, please hit the like button and subscribe only if you enjoyed this content though. That's the only kind of plug I got for this video. So let's go ahead and roll the content. So as you can see here with the first article we got, HIMS Health co-founder just bought $481,000 worth of shares. Over the past year, we can see that the biggest insider purchase was by an independent director, David Wells, for $3 million worth of shares at $8.91 per share. So it's clear an insider wanted to buy, even at higher prices that the current share price is, which is about $6. We've seen lows, in the $5 range. So their view may have changed since then, but at least it shows optimism for the stock at this current time. To us, it's very important to consider the price insiders pay for shares. It's generally more encouraged if they pay above the current price, as it suggests they saw value even at higher levels. So that's one thing I do want to get into right here. One of the famous investors, Peter Lynch, I'm sure most of y'all know him. One of his famous sayings is there's multiple reasons why an insider might sell a stock. It could be tax reasons, it could be the valuation's high. It could be just as simple as they want to take some of their money off the table to invest in other companies to further diversify themselves. So there's multiple reasons, once again, why an insider might sell a stock, but there's only one reason that an insider is buying a stock, and that's because they think the stock price is going to go up, whether that's, in the next 12 months, in the next 5 years. They think that the stock, with the amount of growth that it has in the future, it's at very, low levels. It's an undervalued stock for what the company is going to be in the future. So only one reason an insider is going to be buying a stock, and that's because they think the stock's going to go up. Pretty basic there. Now, the next thing I want to get into, while HIMS Health insiders bought shares during the last year, they didn't sell any. This is a recent SPAC company. The company was, early 2017. That's when the company started. So it's still a new company. Within basically the past year, maybe year and a half, is when it became public. So there's not going to be a lot of, things that we can look back into in the past. So this chart may be a little bit misleading because it doesn't have years of data. But I do think it is important to show this. As you can see here, from the past 3 to 6 months, there's been no shares sold at all. With 360,000 shares bought, which is about $2.6 million. So once again, there's only one reason why an insider buys a stock, and that's because they think the stock price, the market cap of the company is going to raise. So that's one good thing to look at. Now I want to get on to this article that was written by Raw on Seeking Alpha. So HIMS Health, the valuation article. The summary of this that we're about to get into is HIMS is a company that should be considered by investors who are looking for a speculative stock with favorable risk to reward ratio. Speculative, him saying that, I don't know if that's really justified. It is a lower market cap stock, but if you look deeper in the company, I don't really see it as a speculative stock. So the market is pricing HIMS as if the story is nearing its end, when in reality, we haven't even finished the first chapter. I like comparing stuff to baseball. So if you look at the innings, 9 innings, we're not even finished with the first inning. This company, for the next decade, I don't know when it's going to stop growing year over year, quarter over quarter. So that's one thing to consider. So in this article, he provides 3 DCF models, EPS model, enabling investors to see their own forecast and make their own. I've got plenty of research that I've already done on this company. If you want to look at some of the price to sales ratios, the forward PEs that I'm kind of pricing out, the revenue that I see for this company, I usually go out to a couple 3-4 years in the future, because past that it's kind of hard to tell. So comment down below. If I get enough comments down there, then I'll show, and I am a little bit of a conservative investor, so it may be lower than yours, but basically, to summarize, the company's still growing, plenty of years in the future on all of my models that I could show if y'all want me to. So comment down below, and if it gets enough comments down there, I would be glad to share my thoughts on that. So based on the projections and free cash flow and net income, the stock has a potential to return 3 to 4x base case. So that's, an average, the company doesn't really excel that much. They're just kind of doing what they are right now and not really expanding that much, with a 10 to 20x in a bull case. So the executive team, they capitalize on every single thing they can. They start beating estimates quarter over quarter. The company is doing tremendous. They start growing a lot more than expectations, so it has a potential to 10 to 20x. I'm not just throwing this in this video just to get clicks or anything like this. We're simply looking over an article that was written on Seeking Alpha, which had some good points that we're going to get into. So him and hers, this is about catching a falling knife. So I got some thoughts on this subject. Him and hers has fallen from a 52-week high of $25.40 to a recent low of $5.52. which represents a 78% decline, which conditionally has the company's year-over-year growth in revenue last quarter. The stock decline in the past month has basically investors wondering if they're catching a falling knife. Is this stock going to $0 in the next year or so? So my thoughts on catching a falling knife. When the markets, as we saw kind of like February timeframe of 2021 this year, the market was all about growth. Balance sheets didn't matter. All they really cared, is the company growing 40, 50, 60% year over year, just a full risk on. In times like that, that's when you should be scared about the market. Whenever a stock has gotten pushed tremendously lower, think of this. I would rather catch a falling knife at buying the stock at $7 or $8 a share and then going down to $5.50, as to where when the market is nothing but hype. I'm sure y'all saw on YouTube, everybody was posting 10, 20x, 5x, stock returns, like making videos and stuff like that. I would much rather buy a company at $7, $8 a share and then go to $5.50 instead of buying and catching that for real falling knife at $25.40 and then being at $5 and something with a 78% decline. I would much rather that number be a 20% decline. And about the stock going to zero and stuff like that, investors worrying about how much lower this stock is going to go. Stocks, they're irrational, and that's what's good. People hate on that, but that's what's good about an economy like we have, the stock market like we have. It has very high highs and very low lows. It's more about looking and being a good investor, basically. You see a valuation at $25. I would not have touched this stock. I would be, way far away from this stock at $25, even with how much the company's growing, because you can only forecast out so much. But when a stock price gets pushed so low like this is a lower low than it should be. It's undervalued, in my opinion. Even if you're just holding this stock for 2 years, and somewhat holding it long term. Even at 2 years, this stock price, I could see this being a $15, $18, maybe $20 stock 2 years from now. So yeah, about catching a falling knife, I would much rather catch it at, $6, $7, $8 a share than $25 a share. So it's just about being a good investor, looking at what times you should be buying. Like right now, as the making of this video, the market's falling. You should be out there buying, not selling stocks at push down lows. So now we're going to get into a little bit down here on the article. It seems that the market has deep concerns for the company's prospects, that what appears at first glance as good news. Here are some potential reasons why the company's price has been basically down this year. The healthcare sector is significantly undervalued as a whole. I don't really see that. I think there's good value, but there's still stocks that are way above what I would consider undervalued. So I don't know where he's getting at with that. Investors question the company's path to profitability. This guy, he could have been looking, and he's writing articles probably every day. So he's probably out here looking at, 25, 30, 50 stocks. So it's hard for him to really get in the nitty gritty of each stock. But if you, I want to say it was the CFO or something. It was an interview that I was watching of HIMS stock, and he basically said, the end of 2022, they're going to maybe start inking out a little bit of profitability. 2023, as far as profitability, full year, including the 4 quarters, especially when they just start getting profitability. So full year of 2023, I believe they're going to be profitable. They've already said that they're, the end of 2022, they're going to start inking out a small profit. But full year 2023, combining all of the 4 quarters, because when a company first starts getting profitability, there's going to be a quarter here, a quarter there, where it's maybe 2 or 3 cents of a loss of EPS, and then next quarter it's 5 cents of positive EPS. So full year 2023, I do believe, as long as trends don't turn down for this stock and they start doing a bad job or something like that, then I believe 2023 they're going to ink out a very small profit margin. And now investors are concerned new product expansion via outlets will shrink gross margins. That happens with every single stock, and that's your job as an investor to go, in the past, say 2 years in the future, look at their gross margins, see how much they are going down. Whenever you start expanding in a massive way, they just started partnering with Uber to get him and hers health products out there. So the more and more you expand, gross margins are going to get pushed down, because think of it, why would Uber partner with him and hers, or why would Uber partner with anybody unless there's money involved for them too? So the more companies that you use to grow and stuff like that, those companies are going to want a small bit of profit to get your product out there, which it's better for both companies. That increases revenue for HIMS and for Uber. So gross margins are going to shrink. That's like with every single company out there, and that's your job as an investor to go through, like 2 years from now, go through, time periods of right now and look at their gross margins, see how much they have gone down. If it's only like 5% and they doubled their revenue, then that is tremendous. But if gross revenues, or if gross margins fall 50% and they've only doubled their revenue, it's like, okay, so bottom line, we're looking at you're not really getting that much out of growing in these sectors that you are. So that's one thing to look into in the next year or two. It's one basically good thing to look at every single year with any kind of long-term investment. Investors believe the company has no moat and is susceptible to government regulations. I don't know about the government regulations. I think they got a pretty good hold on that. They're not that, they are in the healthcare sector, but government regulations, they're a private company, so they already have a bunch of stuff they have to deal with. I don't really see that being that much of a thing, and healthcare is, it's a needed industry, so I'm not worried about that. And then investors believe that the company has no moat. People said that about, look at, the big companies right now, Apple. There was worries about Microsoft, like is IBM going to beat them out to that? Amazon, everybody thought that was a no-moat industry, back in the early 2000s and stuff like that. And that's why the share price, I want to say in the dot-com bubble, it dropped basically 90-something%, because they thought the company was priced to go bankrupt. And look where Amazon is now. So the no-moat thing that happens to any kind of small company before they get bigger, and then it switches from no moat to instantly like, oh, they have a pretty decent moat now. So that's one thing to consider. Investors fear microeconomic events such as inflation, debt, COVID-19, if anything that helped HIMS stock being a healthcare company. Fed tapering, we already heard 2022 that there's at least one guarantee of tapering, with 2 to maybe 3 in the year 2022 might happen, which is going to raise the rates. Unemployment is actually a pretty decently healthy number, consider where we were a year ago from now. Trade deficits, and then supply chain shortages. So debt, they have a good balance sheet, so you can go ahead and knock that off of. And all the other stuff you cannot control. That's like with any single stock. That's something that you have to consider with every stock right now. So yeah. And then preliminary guidance. This is one thing I was going to look into. The company reaffirmed its 30% revenue growth rate for 2022, but would not commit to more growth. Basically, they wouldn't raise their guidance when probed by analysts. This concerns analysts, and perhaps growth is already slowing down. There's so much changing right now in our economy. What is the supply chain? I feel like that's one of the biggest things that's going to be hitting revenue growth rates. What is the supply chain looking like in 2022? And nobody can accurately forecast that out. That's just one thing that you got to pay attention to as we get, more guidance along, with future months. And that's just basically one thing that's going to impact every company. So I believe that's smart on the management's team to, oh yeah, we're going to raise guidance and stuff like that. So they raise guidance, and then next year, they're missing on every single earnings report. They're missing revenue, they're missing EPS, because they're doing the opposite of sandbagging themselves. So I believe that's a smart job by the management team to not raise guidance going into a year that you have no idea about. So if you made it this far in the video, I very much appreciate it that you did view my video. Please hit the like button as we can get this more out here in the algorithm. If you do like this content, only if you enjoy this content, and if you think it brought value to your investing or something like that, please hit the subscribe button. We're trying to grow this very small channel. I hope y'all have a great day, and catch me back on the next video.